It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. A Bloomberg scoop. The U.S. set to impose tariffs on Chinese EVs and strategic sectors in a sweeping decision to be unveiled by President Biden as soon as next week. Asian stocks rising after an upbeat day on Wall Street with U.S. jobs data supporting the case for Fed rate cuts this year. And as India's election nears the halfway mark, falling turnout may be a sign of voter fatigue with a ruling BJP. Well, as always, let's start with the markets. Get to Avril Hong with the very latest. And Avril, it does seem like caution is appropriate. I mean, one data does not make a trend.
Yeah, but markets were quite quick to jump on it as we saw the surge in jobless claims pointing to a cooling labour market, making the case for the Federal Reserve to cut rates this year. We saw how Wall Street performed, and the Asian stocks were pretty buoyant today, starting the day on the front foot. But I think what we need to keep an eye on are those US-China tensions. They seem to be looming large for the markets today because despite the earlier gains, we're actually seeing the equities pairing some of that surge earlier on in the session, although we're seeing bonds continue their recovery. Now, the Hang Seng has been leading the pack today, but even it has been pairing those gains from earlier in the session, and the CSI 300 has been sinking into negative territory. Let's flip the board and take a look at the movers and what's behind the move in the Hong Kong benchmark. We did see the dividend-related shares, your HKEXs, your Chinese construction banks. Those are the ones seeing big gains today against the backdrop of reports that regulators are considering proposals for dividend tax waivers. But the real drag in the HSI today is coming through from your EV makers amid that Bloomberg scoop that we could see the Biden administration imposing fresh tariffs on Chinese EVs, solar equipment, as well as batteries. And that seems to also be putting some pressure on the broader Chinese tech stocks as we also shift the focus to watch for their earnings next week. They are sinking into negative territory as well. Let's flip the board because I wanted to rake through what this is playing out and how it's playing out for these currencies, because we saw the offshore yuan actually weaken once those lines dropped. The onshore yuan followed suit. Aussie dollar also coming under pressure. Given how it's an election year, it looks like those threat of tariffs will remain. And we have the likes of Maybank already flagging that the gap between offshore and onshore could widen. It looks like geopolitics really in the mix for markets in the region today, Has.
Well, that's right. The yuan is set to be under pressure. Let's dig deeper into that story and that scoop that Avril was just mentioning. Get to that scoop. Bloomberg has learned that the Biden administration is set to impose tariffs on China EVs and other strategic sectors. For more on this scoop, let's bring in our international economics reporter, Eric Martin in Washington. Eric, what do we know so far? What are the details?
Haslinda, what we're hearing from our sources is that this is an announcement that's going to be coming next week. We're hearing from a couple of our sources this is going to be on Tuesday. This is arguably the most important trade decision that President Biden will take during this term. This is putting his own stamp on the U.S. trade relationship with China. He inherited tariffs on more than $300 billion in annual imports from China from his predecessor, Donald Trump. And this is his opportunity. It's something they've been studying for years now in what's called the interagency process. Treasury Department, U.S. Trade Representative, the White House, different parts of the administration debating what should be done. And we're hearing that it's going to be new tariffs on electric vehicles as well as batteries and solar cells. And really, as I said, the most momentous trade decision that President Biden has taken in office.
Eric, this doesn't bode well for U.S.-China ties, and given that it is an election year, you can only imagine that tensions will deepen further.
Absolutely. In this election year in the U.S., ahead of the vote in November, we're really seeing Presidents Biden and Trump in a race with each other, in a competition with each other in a certain way for who can be tougher against China. Certainly in some of the swing states that are typically determinant of a U.S. election, places like Pennsylvania, Ohio, Michigan, Wisconsin, trade is a very important issue. Manufacturing has been hollowed out by the loss of jobs due to what is alleged as unfair competition from China, and therefore trade is a really sensitive and important electoral issue. And this is a decision that certainly has a political element in terms of looking at how to put American workers, this worker-centered trade policy that the Biden administration often talks about, and how to best pursue that, a few months here ahead of, about 6 months here ahead of the U.S. election.
Eric, thank you so much for that. Our international economics reporter, Eric Martin in Washington, D.C. Let's dig deeper into possible impacts on the markets. Bring in our guest, Andrew Ferris, CEO of Ecognosys Advisory. Andrew, let's start with the latest news out of the U.S. China-U.S. tensions once again back to the fore. You got to imagine that might just dent the rally we've been seeing so far.
Yeah, but before we start that, can I just get it out of my chest? This, by all means, impose tariffs on EVs and on batteries and on cellular telephones or whatever, if in fact there is a lot of evidence that these are state subsidized. But please, oh please, please, don't bring this nonsensical argument of excess capacity. If excess capacity is the case, then Elon Musk must have excess capacity coming out of his ears, because apparently he's exporting quite a lot of his output. I'm a PhD in mathematical economics, I don't mind saying, and I don't mind a nice little quantitative definition here. Excess capacity simply defined the output that can be produced reasonably with use of capacity minus inventories. I haven't seen anything like that being dedicated or somehow calculated in the case of China. But I stress, by all means impose tariffs if state subsidies is somehow distorting the prices. And this is what's going to happen.
So, Andrew, might we see an undoing of the rally that we've seen in Chinese stocks?
Most likely, because China does depend for its growth significantly on exports, and this is not going to help. And of course now, said he clearing his throat, what's the European Union? They're going to follow suit. In other words, Biden, in effect, jumped the gun and started out first. And the European Union said they have been saying it and they are going to do it, and now they will definitely do it. And they are going to impose also tariffs on electrical vehicles.
But there are sectors within China's market that may be looking pretty attractive. Here, case in point is perhaps China developers. They continue to extend their gains by 2-3% today. And that's because on the back of cities removing those restrictions on sales. What do you make of the property sector? Is this a pivot point? Is it time to perhaps think about getting some?
You know, again, I'm stuck a little bit on numbers because I prefer not to base things on opinions. Says, well, I've got a good stomach in my feeling that things are better. I'm always looking at the price of accommodation, newly built flats in 70 major Chinese cities. And for nearly 22 months, the price has been negative. They have not been falling. No. They have been shrinking. Once this has finished, I will feel a little bit more comfortable to say that we are looking at perhaps the beginning of the dawn in the property market. Because otherwise, lifting restrictions, remember, you can leave all the restrictions you want, and you can tell people there are plenty of mortgages for you to have at low interest rates, and if there is no sense of confidence in the property market, all this is not going to make any difference.
So, Andrew, effectively, what you're saying is still stay away from China. Never mind that foreign investors are beginning to, dip their toes into that market.
It's not a matter of staying away from China. It is a matter of looking at the potential sectors at which something could or would happen. And property sector is not quite that. Now, on top of that, we have an external factor on the export sectors of, let's say, electronics and cars. And that perhaps leaves us only with things that are of purely domestic importance, leaving aside the property, which is quite a big of leaving aside. So I could begin to roll out some rather weak ideas, but at the same time saying keep away from China is keep away from China whilst these things are happening. And whilst there has yet to be any significant policy measures taken, we had a skew of policy measures that were slightly subdivided and perhaps too much focused on specific areas of the property market.
Andrew, there's been a lot of talk about yuan weakness and how perhaps the PBOC may consider a devaluation of the currency against a backdrop of a very weak yen, all in the hope of supporting the economy. Your thoughts on that? Do you see a major move, big bang move on the Chinese yuan?
Not really, for two reasons. First, remember, a central bank can either fix interest rates or exchange rates, not both. Or they can try, okay, but then that implies a great deal as to how much they are going to use their foreign exchange reserves and the impact this will have on their domestic credit. In the case of China, the PBOC doesn't really have an interest rate policy. Yeah, they have cut some rates, but with a very small amount. And also, it doesn't really have, let's say, a foreign exchange rate policy like Hong Kong has. It has a kind of a snake in the tunnel kind of thing. In other words, it is a managed exchange rate. And the exchange rate has been allowed to depreciate quite a lot. The reasons for that is if they are not willing to push interest rates up in order to maintain the differential, then they will have to let the exchange rate go. Very sensible. Okay, so I don't see anything wrong or bad. In the same way that people said, oh, terrible things are happening in Japan because the yen has weakened. Of course it has weakened, because the Bank of Japan has actually begun to decrease interest rates, therefore widening the differentials to the US dollar. Nothing wrong with that. You know, this horror and terror, missing out 101 economics. You can only have one thing at a time.
The thing is,
so
for the
no,
PBOC,
I don't think anything...
though, Andrew, for the PBOC, though, how much room does it have to cut rates, given that the Fed is staying higher for longer? Might it take the opportunity, perhaps in June or thereafter, when the ECB does start to cut its rate?
Okay, now, here we go. Thanks very much. You raised a beautiful point for me, and that is the PBOC controls primarily quantity. In other words, a lot of the things they do is they say, we're going to reduce foreign exchange, we're going to reduce the reserve requirements of the bank, we're going to change a little bit in the way the reserve requirements have been used. And they are not touching really interest rates, which is absolutely correct. They can either control quantity or interest rates, not both. And they are clearly unwilling to do too much on interest rates. So I wouldn't be surprised another decrease in the reserve requirements of the bank. Completely correct and consistent policies.
Andrew, hang tight. We'll have more with Andrew Ferris, CEO of Ecognosis Advisory. For now, though, let's do a check on how Hong Kong financials are doing. They are up at the highest level since June 2023, and that's on the backs of the Hong Kong Exchange and some high dividend stocks in Hong Kong advancing after Bloomberg reported on Chinese regulators' proposal to exempt individual investors from paying dividend taxes on that city's shares. Take a look at where financial stocks are right now, surging more than 4.5%. Hong Kong Exchange rising as much as 8%. That is the most since November 2022. China Construction Bank up more than 6%. ICBC, Ping An Insurance, as well as China Mobile also among the gainers today. We're also keeping an eye on Chinese property. They are rallying on the back of more Chinese cities easing in terms of the restrictions on property sales. The benchmark itself, it's up more than 8% as we speak. Well, still ahead this hour, MCM Partners tells us why they're expecting a big election win for India's ruling party and how that could impact the private market space. Keep it here with us. This is Bloomberg. Welcome back. The BOE is adding fuel to speculation about the pace of global central bank rate cuts. Governor Andrew Bailey indicating markets are underpricing the pace of easing in the months ahead.
Have changed our view on the likely persistence of inflation, on the second round effects. And I think it's good news. We think there's evidence there to suggest they will be less pronounced than we thought they would be.
All right, let's dig deeper into the debate of central bank rate cut timings and bring back Economist Advisory CEO Andrew Farris. Andrew, markets underpricing cuts, you think?
What underpricing cuts in Bank of England, this was so sweet to hear his statement, because he says, all my economists were busy following the Fed. Now we told them, stop following the Fed. Please. Okay, look at the economy. Inflation looks as if it has stabilized at a relatively low level, and therefore they are not excluding the possibility of a June or a July cut. That's very nice. It's very nice. Let's hope they are not going to do a Fed now, and they will carry on saying, well, depends. Yeah, of course, it always depends. But the Bank of England cutting interest rates is likely, because also it will match the European Union. Not that this is of any importance to any central bank. In other words, they don't say, well, if they're cutting, we're going to cut. Okay.
So likely cuts for the ECB, but pretty unlikely for the Fed, you say, not until December at least.
Yes, absolutely. The reason for that, for me now, it's absolutely very simple. Okay, it is naively simple. Inflation is stuck at 3. Okay, and it is trendless. It is not that it goes 3.8, 3.7, 3.6. It's coming down. Okay, it is there stuck at 3. The target is 2. Okay, so the inflation is still higher than the actual target. So what do you do about that? Well, strictly speaking, you carry on increasing interest rates till you see a clear change in the trend. Now, we had numbers of inflation, CPI inflation as well as the CPE inflation, for coming up 9 months. I mean, we're coming up very close to a year, and it just doesn't change trend. So the normal thing would have been is to begin to increase interest rates. But, of course, the Fed says we're going to cut interest rates. Thereby, I'm left a little bit speechless and a little bit worried if I heard all this right. So the Fed said, we are not going to do anything till perhaps another 2 or 3 months. Now, they have to say till inflation is below 3%, and they're not saying this. So I'm not quite sure whether this is all leading either to more tears. In other words, a few weeks down, a few months down the line, we're going to be at the same situation. It's very straightforward. I want 2% inflation. I've got 3% inflation for nearly a year. I have increased interest rates till 5.5. If necessary, I will increase them again, but I'm not going to cut them. Well, that's not what the Fed is telling us. And why should the Fed say anything that Andrew Farris would like to hear? Okay.
So, Andrew, if you are right, and if 3 is the new 2, USD exceptionalism will continue till the end of the year. How do you play this market? What are your biggest bets? What makes sense?
What makes sense? Is not to worry too much about the Fed. For 1 minute, I'm not saying disregard the Fed. That's completely stupid. Okay, but pay attention to the Fed in a kindly, patient way, and in between, find the absolute obvious. In other words, going to markets that are not really all that closely related to movements in interest rates, and particularly in official interest rates. And of course, I'm sorry, I'm going to repeat that again, and I really apologize, but what can I do? Defense stocks are going gangbusters. And you know what? Defense stocks don't rely on interest rates. Why? Because their major client is the state. And the Fed is not going, the American government is not going to say, we're not going to buy fewer bombs because, you know, interest rates are increasing, or we're going to buy a lot more because interest rates are falling. And you have a spread of potential investments right through both Asia, Pacific, and of course, United States and the European Union. Yeah,
so
I know there is a morality issue.
All defense stocks, Andrew?
Yeah. Yes,
you're liking all defense stocks right now across the US, Europe, as well as Asia?
It would have been absolutely stupid for me to say there are something like 36 different defense companies. Tell you buy all of them. That's absurd. For compliance reasons, I cannot actually say, yeah, buy A and don't buy B. Okay, but there are some that there are so obviously good investments that you don't need me to know that. And also, I'm sorry, this is incredibly amoral rather than immoral. Okay, the wars are going on. Nothing is going to happen for quite a while in Gaza. Okay, most definitely not in the case of the Ukraine. And of course, Australia, South Korea, and Japan are arming as if there was no tomorrow. And all this has to do, of course, with the positioning towards China. Yeah.
When we take a look at the opportunities in Asia, you have to look at India. Foreign investors in particular have been putting a lot of money into that market, and assumptions are that another Modi government would ensure policy continuity. How attractive is the market? How much has already been priced in, given how elevated the market is right now?
Three points here. One point, I'm sorry, it's repetitious. India has got a big defense sector, and actually, it is possibly the third biggest buyer of defense in the world. I mean, this is a seriously big market. So they are not only making, but they're also buying. But I'm not interested in buying, I'm interested in making. Number one. Number two is, looks as if Modi is going to be re-elected, and that's very good for stability and continuity and popularity. Okay, this is a big democracy, and if they like what they see and they buy it again, this is extremely good news. And the third point is for us to carry on repeating to ourselves that India is not an export-driven economy. India is a domestically driven economy, and anything that improves investment, and particularly investment in infrastructure, is extremely good and extremely attractive. And of course, there is a very big domestic market. But that is an altogether different proposition. I stick to my infrastructure investment. So yes, attractive, yes.
We had JP Morgan saying today that India is on track for its bond inclusion. Is that a game changer?
Not really. I'm sorry. I've heard this so many times. You know, 3 or 4 years back, it was Chinese shares that are going to be included in the Morgan Stanley Capital International. Wow! Look at now at this Shanghai market. Has been consistently down for the last 3 years. In other words, yeah, it is very useful to have it. And possibly there could be a little kick while some of the funds adjust their holdings. But it is good long term, but it is not buy them now. No, not at all. It is useful, but not exciting. And also Bloomberg
Andrew,
is putting
candid with your
in.
comments. Also candid. Andrew Ferris, CEO of Ecognosis Advisory. Thank you so much for your time today. Have a great weekend. Plenty more ahead. This is Bloomberg. CSI 300 index under pressure on a day when the rest of Asia are actually tracking gains in the U.S. We're doing a check on China EVs in particular, the likes of BYD, NIO, all under pressure right now, down about 2 to 3% on the back of the Biden administration set to impose tariffs on China EVs as well as strategic sectors. It is set to unveil a sweeping decision on China tariffs as soon as next week, and that's according to people familiar with the matter. Now, the decision is a culmination of a review of so-called Section 301 tariffs first put into place under the Trump administration in 2018. It will focus on industries including EVs, batteries, as well as solar panels. We're also keeping a track on Chinese property in the opposite direction. Take a look at how Shimao property is surging 50% right now. That's on the back of reports suggesting about 60 cities have canceled the lower limits for mortgage rates. So, an up day for Chinese property. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. China markets just heading to launch CSI 300 index under pressure on a day when Asia is actually tracking gains on Wall Street overnight. Take a look at that. That benchmark down about 0.3%. We know that EV plays are in particular under pressure in the back of the Biden administration, set to impose tariffs on China EVs, strategic sectors, and that's according to people familiar with the matter. Taking a look at where the yuan is trading, currently at 722.52, slightly weaker versus the USD. That yuan fix remains pretty tight. Now, we talk about those EV plays. That decision is a culmination of a review of so-called Section 301 tariffs first put in place under the Trump administration back in 2018. We're also keeping an eye on property stocks, Chinese property stocks getting a lift. In fact, some, one in particular, surging by about 50% on the back of cities removing those restrictions on sales, lifting sentiment at the same time. As China goes to lunch, Japan back from lunch break. This is how it's looking for the Nikkei 225, inching upwards. It is up by 0.5% right now. Front and center, of course, it is about the yen and when we might see intervention, or might we see the BOJ raise rates. Expectations are that the BOJ might just do that more this year. Nikkei 225 up 0.5%. Topics also higher. And the yen trading at 155.71 versus the USD. And it is also a busy week for earnings in Japan. Let's take a look at some of those that we're tracking. Japanese earnings with a focus on automakers. Nissan shares swinging as analysts see risks to its operating income guidance and the pace of profit recovery. Nissan did post full-year forecasts that beat expectations. Meanwhile, Honda, Mazda set to report earnings today. Honda investors will be watching for strong profit guidance for the fiscal year after a robust fourth quarter. Analysts also expect a share buyback. Mazda, meantime, boosting its operating income guidance for the year earlier this week. Mazda down 2.3, Honda lower by 0.5%. Now let's stay on earnings. Singapore lender OCBC's first quarter profit beat estimates. It's also made a 1.4 billion Singapore dollar offer for the remaining stake in wealth manager Great Eastern. Let's get the details from Avril Hung. Avril, what's behind this offer?
Yeah, Has, I think this offer and the move behind it is really speaking to OCBC's strategy to tap on rising Asian wealth. As you know, it's already got pretty strong positions in Singapore, in Hong Kong, in Dubai, and this latest move could go some way in helping to solidify its leadership position in wealth management. So this offer is 1.4 billion Sing dollars for the about 20% remaining stake that it doesn't already have in Great Eastern. It's at a 37% premium to the last trade, but OCBC did say that it expects its capital strength to still be there, still remain. Indeed, among the three big Singapore banks, it seemed as having the greatest capital strength, and this latest move might also go some ways in helping OCBC to keep pace with its peers UOB and DBS. As you know, those two lenders have been working to integrate their retail businesses in Asia from Citigroup.
So earnings beat, Avril. Question really is whether that is sustainable going forward.
Yeah, I mean, it wasn't just OCBC that beat, it was also the two lenders. So it's been a pretty good quarter for the three of them, but I think it sells or helps to allay some of the concerns because wealth, trading fees surge. We also see how the lending revenues were quite robust, where there is some concern, and speaking to your question about how sustainable this is in the net interest margins. It has come down from the previous quarter at about 2.27% now, and the worry is that as these funding costs rise, that could come under further pressure. Don't forget how savers might want to lock in these higher interest rates before the Fed turns dovish. We're also seeing some pressure potentially coming through on its asset quality. The spike in the non-performing assets, that's also something that we'll be keeping an eye on.
So the overall outlook, how does it look for the next 12 months? It's a difficult environment for a lot of the countries that Singapore banks operate in.
Difficult environment, but at least for the first quarter, they've been faring quite well. So it shows how their lending profits are still holding up despite this higher for longer interest rate environment. To your point, into the first half of this year, I think the demand from businesses might still be quite weak. But if you take a look at the broader macro picture, in Singapore, you see imports and exports also picking up. So the idea here that could trickle through into business activity and corporate loans, we could gradually see the improvement in the later part of the year.
Hopeful. Avril Hong, thank you. Now, a key factor in earnings is the strong dollar and its impact on Asian FX. Here's a look at some major currencies. And the renewed weakness in the yen, despite suspected intervention from Japanese officials, is raising speculation of a new currency war in Asia as export rivals try to keep pace. For more, let's bring in MLive strategist Mary Nicola. Wow, I mean, there's a lot of talk of intervention, but so far, I mean, it does seem like central banks are propping up their currencies, not devaluing their currencies.
Yeah, it's interesting because you've been hearing a lot of talk about competitive devaluation within the region, and especially because of how weak the yen has gotten. So putting a lot of Japan's export competitors under pressure. So, but we have to keep in mind, actually, there was some analysis that we did on the blog that focused on, what does it mean for the currencies to depreciate and what's the impact on the equity markets? So, for example, Taiwan's equity markets, and same with Korea, actually does worse every time the currency weakens. They benefit from currency strength because we have to remember that the overall environment when their currency strengthens means that it's a positive risk sentiment, right? So given their high beta and their sensitivity to global growth, they do better, the equity markets do better when their currencies do better.
Even the yen, there's a limit to how the weakness is supporting exporters. I mean, it's already stopped, I guess, helping automakers in particular. And likewise for the yuan, there's a lot of talk about yuan devaluation. That would help the economy, but in terms of sentiment for investors, that may just go the opposite direction.
Absolutely, and we've got to keep in mind where the fixing has been and how the stability of the yuan, especially with the economy facing some, it's still not, it's not fully convinced that there's some stability. We're getting signs that there is, but especially if we want to get that oomph out of the economy and that extra that we want to see, you need to see a stable currency as well. And so that's what we're seeing from policymakers, is that they're placing the fixing strategically around 710, not trying to rock the boat. And that's absolutely vital, especially for capital flows.
Not to mention, Mary, we also have the U.S. saying, don't you dare intervene. I mean, we had the U.S. saying exactly that to Japan.
Well, it's not only that, it's especially for, let's say, take China. It puts them in a very precarious situation if, let's say, they do engage in what seems like a competitive devaluation at a time when we're getting extra tariffs, as you mentioned earlier, and at a time when they're in Europe trying to also placate any issues when it comes to fears of dumping. So them engaging in some sort of competitive devaluation really does put them in a precarious situation.
Again, between a rock and a hard place. So what do you see, how do you see Asian currencies performing in 2024?
Especially with the higher for longer mantra staying, they are going to remain under pressure. There's no question. I mean, how do you ignore U.S. two-year yields near 5% when the others don't offer such attractive short-term yields? So in that sense, it's going to be more focused on the dollar, and currencies here across the region are still going to remain in a very precarious situation.
Especially Indonesia, especially Thailand, as well as the Philippines. Mary, thank you so much for that. MLive strategist Mary Nicola there. Well, still ahead, MCM Partners shares their views on the Indian market as they expect a big win for Prime Minister Modi's ruling party. The managing director will be joining us next. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching India Focus, and we're counting down to the India Open now, about 4.5 minutes or so. Futures pointing to a higher open. Sensex up by 0.1%. Nifty index also up about as much. You got to wonder, perhaps we're near the peaks, given that the rest of Asia are gaining by more than what we're seeing in India. In terms of the rupee, 83.48 is the level we're looking at. Of course, investors said that the low turnout in the Indian election is weighing on Indian markets right now, with the country's main stock index suffering its biggest one-day drop in 4 months on Thursday. One stock we're watching, by the way, is State Bank of India, topping estimates on lending income, also planning to more than double the pace of new branches this year. But there is a risk. This is, of course, the country's largest lender. State Bank of India currently up 0.8% in terms of futures trading in Mumbai. Let's stick with India. The general election nearing its halfway mark, but falling turnout is prompting concerns about voter disengagement. The lower participation is also raising questions about support for the ruling party, with uncertainty spreading to financial markets. For more, let's bring in our government reporter, Sudhi Ranjan Sen in New York. Sudhi, put this in perspective for us. What could lower turnout mean for either side?
Well, I mean, a lower turnout to begin with, it's not good because in India we have seen over the past few elections or several elections in the past, it's been a continuous rise. So a lower voter turnout doesn't, it doesn't augur well. Now, what does it mean for, say, a Prime Minister Modi or the opposition alliance led by Rahul Gandhi? The jury is still out there. There's no clarity as to which way it's going to benefit or which formation or which party it is going to harm. One of the reasons for that is micro level data is still not available. Therefore, a very clear, definitive understanding or clarity as to who or why this, who this is going to harm is not yet there. But it is an issue of concern because traditionally what has been observed is a high voter turnout is, at times when on the ground there is anger or against the government, a high voter turnout sometimes means that people are coming out in large numbers to vote against the government. Similarly, if there is a very favorable situation on the ground, the one that we saw kind of in the last elections in 2019, when India had just, Indian jets had gone across the border and bombed suspected terror camps in Pakistan. Hundreds and thousands of people came out to vote just to say that, we are with the government. So a higher voter turnout, means different things, but is always good. In this case, voter turnout falling, not a good sign.
Sudhi, how much of this has to do with COVID-19 deaths in India?
Well, that is a very interesting thing that is coming up, and some of the watchers, election watchers, pollsters are talking about it, politicians are talking about it, and the reason being is that India has underreported deaths, and this is an allegation that has been made against the government over and over again, and it has also been borne out by reports of multilateral bodies like the the World Health Organization saying, giving an estimate of COVID deaths which are as nearly 10% higher than the official death toll that government of India had given. Now, why is this important? It means that the electoral rolls have, was not cleared up after the COVID happened. So people who have died in the pandemic are not there. So therefore, these people definitely cannot come out and vote. That could be one of the reasons for the lower voter turnout, as is we get to hear from politicians and pollsters, is that there is no overarching issue in this election, like we have seen in the past few elections, and therefore voters are not really enthused in a way to come out and vote.
Sudhi, thank you so much for that. A government reporter, Sudhi Ranjan Sen in New Delhi. Quickly, let's do a check on Indian markets as we count down to the Indian Open. We know that we saw some gains earlier and those gains persisting as we count down. India Open just in 15 seconds from here. Meantime, the Indian rupee is at 83.4825 versus the USD. Of course, we're looking at a strong dollar environment. And if you recall, I guess earlier today, expecting USD exceptionalism to continue till the end of the year. Sensex index up 0.1% in the early minutes of trading. Nifty index is also in the positive. Now, while investors are weighing the potential election performance of Modi's BJP party, private markets investor MCM Partners is confident the Prime Minister's party will secure a strong victory. To discuss, let's bring in Janavi Bhagwati, MD of MCM Partners. So regardless of what the nerves in the markets are saying right now, you say it's going to be a strong show for Modi and his party.
Yes, because if you look back in history, the only time a party has had majority in the last 32 years has been in 2014 and 2019, and it was both under Modi. So he got 282 and 303. Consecutively. So it's been going up, and he needs over 240 to secure the majority. And I believe that voter sentiment is such that he's popular, he's viewed as pro-business, he's viewed as helping the economy. So I do believe that he's going to secure a victory higher than the last election, which was in 2019.
What would be a third term mean for business? What would it mean for policies? What are you anticipating?
More of the same. Continuity and stability are the themes which are going to be prevalent. So Modi has been pro-business, as we saw. The G20 summit in September 2023 was a huge success. He has had schemes like the production incentive scheme, which gives outside companies incentives to come and invest in India, in the manufacturing sector, the Make in India scheme, which has brought in companies like Samsung and Apple already. So I think we're going to have more of the same. Lots of infrastructure spending, 100 billion has been spent in the last 3 years, 54,000 kilometers of highways made and 202 in the implementation stage. So I think Modi is going to continue, and especially if he has a big majority, execution will be easy for him.
So manufacturing, infrastructure will benefit,
yes,
but still not enough to create the kind of jobs that India needs. What will it take for that to happen?
So I think that's a very good point that you're making, Haslinda. Of the 1 billion eligible people to work, only 100 million have formal employment. The rest have sort of partial employment. So that's a big issue. But I think as we invest more in infrastructure and in manufacturing, that will create jobs. And one can only hope that it will create all the jobs that we need. But also another segment of the population that I think is missing is that only 20% of Indian women are part of the workforce. So Modi is going after sort of laws and regulations which inhibit women from working.
We've had a guest saying that India needs to grow at a faster GDP pace than what it's showing at this point in time. 8, 9, even 10% growth is needed. There's a risk right now in terms of where oil prices are, and there are expectations that oil prices will surge further given tensions in the Middle East. How much of a risk is that? How much of that will weigh on India's growth?
So I think the answer to that is twofold. First of all, India is the third largest country in terms of renewables today. So while we are a net importer of oil, we also are heavily investing into renewables. We're the fastest growing country in terms of using renewable energy and producing renewable energy, and 40% of our electricity comes from renewable energy sources. The second part of my answer is that India has sovereign contracts with Russia, with Saudi Arabia, with Iraq, which are long-term contracts, 3 to 5 years. So they will not be as affected by short-term volatility in oil prices and spikes. But you're right, the corporate sector will be affected, and that will need to be managed in terms of an oil price shock.
What are you seeing in terms of what your clients want? Family offices, where is money headed into? What sectors are they interested in? What are they not?
So I think the sectors that continue to be popular are tech. So AI, cybersecurity, they all continue to be very popular. Fintech, payment companies are very popular. I think the sectors which are not popular and where investors are not confident, at least in the private market space, private credit deals where they have to lend money to companies, because there you need to verify the collateral. There I find investors going in more in a fund structure where somebody else has sort of vetted the companies and done the first layer of due diligence.
In terms of deals, are you seeing like family offices coming together for direct deals? Is that a trend that's picking up?
Absolutely, because family offices tend to know each other. People with a certain amount of wealth know each other, they socialize together, and if you're coming into a deal and you share, somebody else comes in with you, that gives you an added layer of security, because each family office will do their own due diligence, their own vetting. So if I come in and my friend comes in too, I have an added layer of security. So I'm definitely seeing that.
You know, we're seeing
club deals, so it's called the club deal phenomenon.
In terms of entrepreneurs, why are they choosing family offices versus private equity? What are the advantages?
So first of all, family offices can move much faster. Private equity and the larger institutions, it takes a longer time for money to move. Usually the decision maker in a family office decides and you can go right ahead. The other factor I would say, Haslinda, is that private equity need to return the money in 5 to 10 years, whereas family offices can keep the money in for as long as they want. So it's very attractive for entrepreneurs because of that.
Janavi, always good to have you with us. Thanks for your time today. Janavi Bhagwati, MD of MCM Partners. Now to more top stories we are following out of India. JP Morgan says it's on track to include India in its emerging market debt index from June, with most of its clients ready to trade. The firm's global head of index research told Bloomberg market feedback so far has been largely positive. JP Morgan estimates foreign inflows of between $20 and $25 billion, assuming an index neutral position. India has been outperforming this year in a Bloomberg gauge of global sovereigns. Air India Express says it's ended a standoff with cabin crew agreeing to bring back workers it had fired for calling in sick en masse. Air India's low-cost unit had to cancel dozens of flights this week after more than 100 cabin crew reported sick at the last minute. The carrier is currently integrating with AirAsia India as part of its aggressive expansion plans. Plenty more ahead. Keep it here with us. This is Bloomberg. All right, let's take a look at benchmarks in Hong Kong. The Hang Seng currently up by 1.7%. 8 shares up by 1.8% at this point in time. HSTech, though, in the opposite direction in negative territory. We're keeping an eye on that property index in particular. China property stocks gauge rising as much as 9.8%. Shimao jumping 73%. What a search for that property play in particular. Of course, China properties in focus on the back of reports suggesting that about 60 cities have cancelled the lower limits for mortgage rates and purchases of first homes since 2023. Of course, we have seen how China in particular has made changes to its policy when it comes to property purchases to perhaps prop up the property sector. In terms of southbound flows into Hong Kong, this is how it's looking. Only 2 days of outflows since early February. It does seem like mainland Chinese investors are buying into Hong Kong, driving that flow that we're seeing at this point in time. Take a look at that. Only 2 days of outflows since early February. Well, we've been talking about how there's been a lot of interest in the property plays. If you can actually bring that up and see how those stocks are playing at this point in time. Shimao property surging 63%, Agile property up 18%. So quite a surge in terms of the property plays. And as we said earlier, reports suggesting about 60 cities have cancelled the lower limits for mortgage rates. And we've increasingly seen cities in China doing all it can to support the property market. In terms of the overall look in Asia, higher tracking gains on Wall Street after those jobs data supported the case for Fed rate cuts. That is it. This is Bloomberg.